to set the stage, this is a conversation about the challenges of investing institutional assets in what we might term the post-pandemic era. What I'm talking about, of course, is the so-called real money. This is the cash entrusted to foundations, to endowments, to public pension plans, and sovereign wealth funds. This is patient capital with I should say, weighty responsibilities. It is not Davy day trader global money. And that should give you a sense of what to expect from our panelists. I'd like to introduce them. Brooke Jones is Director of Investments at the Carnegie Corporation. Carnegie is one of America's oldest grant-making institutions, but also one of the most forward-thinking investors in the foundation space. Brooke plays a key role overseeing Carnegie's $3.5 billion in assets, co-leading its public markets exposure across equities, hedge funds, and fixed income. And Joe Dowling is the CEO of the Brown University Investment Office. He joined Brown as the Chief Investment Officer in 2013. He's now the CEO, as I mentioned. He's since built one of the best performing endowment teams in America, and it's important to emphasize the team approach. You won't find Joe taking a great deal of credit for Brown's extraordinary performance, and the performance has been something to note. Brown's 2019 return was 13.4%, and with the fiscal year end approaching on June 30th, Joe might, if he's feeling generous, drop a few hints about how Brown has performed through the pandemic. Brooke and Joe, welcome.
Thank you.
Thanks for having us.
As all of you know, we've been doing some polls throughout this virtual conference. And for the audience, I've got another for you. Here's the question. Is there a limit to what central banks can do to shore up the markets? You're going to see that question pop up on your screen, and I want you to answer one of the following. Number one, no, there is no limit. Smart policy implemented correctly can stave off the worst effects. Two, to a certain extent, unlimited rate cutting isn't a long-term solution. And number three, yes, central bank divergence and unlimited borrowing bring significant risks. You're going to have to answer one of those three. Unfortunately, don't fight the Fed is not one of the options. So you can't go there. So I'll let you answer. And it seems, based on what I can see on my screen, that option two, to a certain extent, so the middle ground, if you will, it's neither a hard no nor a hard yes, but we're getting 58% of respondents saying that to a certain extent, there are limits to central bank stimulus efforts. Now, those stimulus efforts have certainly helped to reflate assets since the March lows, but our two investors here certainly aren't banking on whatever it takes to generate positive and healthy returns over the long run. Brooke, I'd like to begin with you. Help us understand what an institution like yours, Carnegie, is dealing with, some of the challenges that institutions face at this moment in time, looking backward, but more importantly, looking forward.
Well, I don't think Carnegie's alone in this, but if we think about the broad endowment and foundation ecosystem, all of us had quite a bit of illiquidity leading up to the crisis. And despite the fact that assets have reflated, we still have a lot of illiquid assets that have to liquidate. You and I have talked about this before. And when there's a shock to the system, you tend to not see distributions. And so I think a lot of organizations, Carnegie included, is wrestling with that liquidity profile will look like over the next several years. And if you're a college or a hospital system or anyone who's taken a foundation, who's taken a direct hit to your actual operating model, not just the endowment, that liquidity question is very present.
So walk us through that a bit more for those who don't understand the importance of liquidity in the balance between asset and liability management at an institution, whether it be a foundation, whether it be an endowment, whether it be a pension plan, for example. Why is liquidity so important? And particularly at a time like this?
Liquidity matters because at the end of the day, we are fiduciaries trying to meet our obligations, and our obligations of the foundation are to our grantees. And in this particular moment in history, too, we feel that obligation even more so because we are supporting social aims. And this is a moment in our country where that is as important as it ever has been. I think that's true. I'm sure Joe can speak to colleges who've seen their revenues hit from rebates on room and board, families that will be more stressed and need more financial aid in the coming academic year. So regardless of the type, we are here to serve the organizations that we are supporting, and they need more support today when liquidity is potentially more scarce.
So, Joe, Brooke gives us a good opportunity to pivot to you. I once had a conversation with Steve Schwartzman, the founder and CEO and chairman of Blackstone, in which he told me liquidity is overrated. And it seems to me that based on what Brooke is saying right now, that statement, which may have been true at the time, may not be true today. And in particular for institutions, many of which have allocated large, amounts, if you will, or large percentages of their portfolio to private assets, not just private equity, but most recently private credit. Some have exposure to growth equity and venture capital, all of which don't trade very much in the secondary market, all of which could be called illiquid. What do you think?
Well, Erik, following up on Brooke's comment, I think one of the things that's difficult for us at this stage is that we do not know exactly what the scenario is going to be for the students returning, at least to Brown. We know that our president, Christina Paxson, has been out front on this issue. She's testified before Congress. She wrote a very nice op-ed in the New York Times, but it's still a logistical Rubik's Cube. So we want to make sure that we have the full resources to bring our students back safely, because that's the most important thing, and to have our community be safe. And that's going to mean additional costs for testing, and it's also going to lead to a deficit during the first year, depending on what percentage of students come back to school. Most endowments and foundations right now, I believe, are paused, and they're paused largely because they don't know what their funding responsibility is going to be.
So they don't know what their funding responsibility is going to be to their constituents. At the same time, Joe, a lot of these, again, institutions, endowments, foundations, and the like have enormous forward commitments to funds, private equity funds and other funds. How are they going to, on the one hand, meet the demands of the institutions that they serve, or the organizations they serve, and at the same time answer the capital call from Blackstone or Apollo or Oaktree? I could rattle off a million other names. It doesn't really matter. You can sub in whatever you like.
No, you're exactly right, and it all comes down to in a well-functioning private equity portfolio, what happens is your distributions fund your capital commitments. But now in this environment, you can play with the cash flow model and figure out what you think your distributions are going to be, but they're not going to be equal to your capital calls, and that causes a deficit. In addition, we fund about 16% of Brown's operating budget. It's roughly a $185 million number every year, and so we've got a plan for that. So it's going to be, we run a 3-year model, and we're prepared. We've been playing offense, actually. Our CFO just went out and raised $300 million in the debt markets, and so we've got quite a lot of runway under all scenarios.
Brooke, it sounds as though, Joe's put a plan in place. He and his colleagues have put a plan in place that might make things not as challenging for Brown as they could be otherwise. Tell me, what do you think is going to happen across foundation and endowment land? Is it going to be crunch time, as far as liquidity is concerned, and meeting these capital calls for future commitments?
I think it really depends. So if you're like Joe or you're like Carnegie, where we were prepared of mind and also in the portfolio for some kind of correction, then you weren't running so full sail that a surprise to your liquidity prospects would force you to be in a difficult default position, God forbid, or something worse where you're worried about supporting the operating needs of your organization. So I think for those who were thoughtful and prudent and had either enough cash on hand and thought through how many years of payout or operating budget they needed to provide. We're not worried about the existential needs of meeting the organization's payout requirements or our capital calls. In fact, I think in all of our stress scenarios, we're not at all worried about that. I think what we want to make sure we still have is enough flexibility in the portfolio to play offense, like Joe mentioned. But there will be those who I think are exposed, who felt, for whatever reason, career risk, a sense of obligation from the governance structure to be a little bit more aggressive and a little bit less cautious. And that happens often at the end of a bull market. And I think those are the institutions that might have to worry a little bit about the coming couple of years.
It's important to talk about offense, and we're going to get to that in a moment. But before I do, I have a couple of the questions for both of you. Brooke, you mentioned that you'd been positioned, I don't know if you used the word defensively, but I read it as defensively. And Joe, I get this feeling that Brown also was somewhat defensively positioned, or at least positioned in such a way that you were able to go on offense now. Why was that? Why did you enter 2020 in a fashion that wasn't leaning so hard into risk? I'm trying to keep this from being a macro conversation, but I think it will be helpful for people to understand what you were thinking then, because that helps to explain why you're thinking the way you are now. Why don't we start with you, Joe?
So Brown was fortunate. We had low exposure to EM, and we had eliminated a lot of our passive positions at the end of last year. So we were North American centric, and we had quite a lot of capital, about 37% of our capital in hedge funds and market neutral funds defensively. So we were able to weather the storm pretty well.
Now, I'm going to get to Brooke in just a second, but why was that? There were so many other people. Look, the market was, we only need to look at what was happening in January and February. That was not a conventional point of view at the time to sort of step back from risk, pivot to market neutral, maybe raise your cash position. Yeah. I'm not sure exactly what you did, but clearly you were out of step with what, quote unquote, the market was up to.
Well, Erik, we're trying to design an all-weather portfolio, so it may seem that we just did it at the last minute, but we had a series of steps over the last couple of years, and where we're trading off different asset classes to optimize our risk-adjusted return, which we focus a lot on. We can talk about it a little bit later, but we're very sharp-oriented in our portfolio, very analytical, understanding what factors we're exposed to. So we sort of felt like we'd rather be in the hands of more active managers at the tail end of last year, that the band between active and passive had been stretched too far, much like I think value and growth has been stretched too far now. So we also benefited from the fact that we sold all of our oil and gas private investments about 2.5 years ago. So that was just darn lucky. So sometimes it's better to be lucky than smart.
Some very timely dispositions. Brooke, what would you say are some of the things that similarly distinguish the approach that you take at Carnegie? For example, because we talked about it, you and I did back in January, you had a significant position in hedge funds, which was, again, sort of counter to trend relative to what was happening at a lot of other institutions.
So much like Joe, we were a little bit, I guess, worried about the environment, but much like Joe, we were not doing this in a rapid trading fashion. We started rebuilding our absolute return portfolio in a relatively methodical way. And we did it in part because we think markets have cycles and you can't predict when they turn, but you do want to have some measure of diversification. And when valuations start to look and feel stretched, which is something we attend to very, very closely, then there's a way to express that point of view. And part of it was just a bottom-up decision. We would look at a private equity fund that we loved, but we'd look at the underlying deals in pipeline and the valuations and the leverage levels and say, that looks a little stretched versus your history. maybe this is a smaller bite size this time around. Or in the public markets, a similar decision. This looks a little full, let's shave the top. This looks like a little cheap, maybe we should start averaging down. So there's nothing heroic. It's very methodical and thoughtful and guided by where we think things look like in the evaluation cycle. And that helped put us in a position at the end of the year, beginning of this, where we had 22% in hedge funds. We'd been adding, others were fleeing. We had about 11% in cash, which was much higher than peer. And that's, like I said, put us in a good position to make sure firstly, that Carnegie is well served, and secondly, that we can start to think about offense.
I should ask, how did that hedged exposure perform, through the depths of the crisis and into the reflation?
Good question. The answer is mixed. So on the first end, the long-short portfolio did exactly what we had hoped it would do, which was wonderful. So we had some protective qualities. All of our managers were pretty thoughtful about pressing, or in most cases, covering some of their shorts and taking profits. And then we saw a lot of renewal in that portfolio as well. So it did what we thought it would do. It fulfilled its role, and it allowed us to sort of amplify that ability. It's TBD, because the first answer is it didn't do as well as we would have liked. And I think the question is that because we were in the wrong spot and we made the wrong decisions, or was it a byproduct of a particular type of shock that we experienced? And that's something we're still thinking through.
I'm going to continue with you for a second, Brooke. As you've both established, one of the things that institutions need to wrestle with now is the question about how much risk you want to take on, how opportunistic do you want to be, and does the new environment that this situation, this pandemic has created, demand a change in allocation? Tell me about what you're leaning into, what you're leaning away from, some of the debates that you and your colleagues at Carnegie are having right now.
So we are an independent and thoughtful group of people who like to debate these things, and it has been a very live and fruitful one. So we have been really light on credit in the portfolio. When I mentioned that event-driven opportunistic part of the portfolio, it's a much smaller part of our absolute return book. And the debate for us in the midst of the drawdown was, with the rebalancing dollars we do have, where does this go? It doesn't have to be black and white. It doesn't have to be all in one thing or another. But do we add it to U.S. equities? Are we adding it to our long short in a long short format, or long only? And are we saving some for credit? And that took a lot of work and focus on actually our relationships and the exposures that we were getting through them. But in our immediate decision, we did a little bit of rebalancing into equities, but we've saved money in our liquidity budget for being a little bit more opportunistic in credit. I don't think we've seen the end of that. And it goes back to your earlier point of the poll question: can the Fed save us all from everything? And I think we so far think no. There will be continued pain and in the real economy, and that will create opportunities both for long and short sellers, but also for credit managers.
Now, when you say you're saving a little bit of money for credit, we're talking about an allocation of what size?
That's a good question. That's active debate. So I'm going to defer to another day, and I'll let you know what the outcome is when we finish.
Well, that might be a good thing, because I know a little about how Joe thinks about credit and how he's evaluating it against other opportunities. Joe, do you want to disabuse Brooke from her thoughts on opportunistic credit?
No, I mean, look, we have some very good credit in our book. We're big fans of Owl Rock, which is a direct lending BDC, which we were one of the founding shareholders of. But when I look at the distressed opportunity set, what I see is restructuring old economy businesses, many who are being disintermediated, the dinosaurs of the world. So someone will make money off of restructuring Macy's at 2 times enterprise value, to EBITDA. but it won't be the bear. The brown focus is on taking advantage of the companies that are doing the disintermediation, the growth stocks, some fintech opportunities in Europe we're particularly excited about. We also are taking advantage of what I'm seeing is a lot of forced selling in the market. There hasn't been a week that we haven't been offered somebody's to take over someone's forward commitments. So let's say someone's made a $100 million commitment. They're only invested $20 million, so they're 80 on the hook. They've come to us and said, we'll give you the first 20% at a 40 to 50% discount if you take the forward commitment. So I think there's going to be a lot more of that. I think people are over leveraged in private equity, and when they start to run their cash flow models, depending on how long this goes on, there are going to be a lot of surprises, in my opinion. We're also taking advantage of EM equities. For people that know me, this is the first time that I've been bullish on EM in 5 or 6 years. And it has to do with the opportunity set versus the US and the amount of printing that's going on in the US. We've had $3 trillion of stimulus. It's a 72% expansion of the balance sheet, and I think it's going to pressure the dollar quite a lot.
Joe, just a moment ago, you mentioned unpleasant surprises, I think. You certainly mentioned surprises. What kinds of surprises do you see lurking around the corner, when you use that word?
So there's a thing called the denominator effect, which is when the market goes down, your privates become a larger percentage of your overall asset allocation. And I think many people are in endowments, foundations, state pension funds are over their skis with these investments. And you won't see it at first. People will be able to make adjustments. They'll be able to take out lines of credit. They'll be able to sell things in the secondary market. But the longer that we go into a flat return environment, those forward commitments just keep creeping up on you. So I wouldn't be surprised to see a few people doing more forced selling in that area.
Brooke, we have a little bit of time left. Do you have a similar point of view? We began the conversation on the point of liquidity, and to a certain degree, that's what Joe is talking about, the lack of liquidity in the portfolios of other institutions. It's something that both of your institutions, your organizations seem to have managed well. But do you see those same kinds of stresses, those same kinds of nasty surprises?
I do. I think that's why I disagree slightly with Joe that it's the only opportunity that's going to come in the next several years is to buy high quality growth businesses. That's a great opportunity, and we have a lot of that in the portfolio. But if that liquidity waterfall is going to hurt the funders, and I agree with him, I think it will, then it's going to start to hurt the private providers of capital, the private equity players, and the private credit players. And you're going to start to see companies that are maybe not the early stages of a credit cycle where a company that's challenged already was close to the point of bankruptcy anyway, and this is like the straw that broke the camel's back, filing. You're going to start to see companies that have financing walls because of that trickle down effect. So I think that liquidity waterfall is going to maybe create some opportunities in the secondary market, as Joe is experiencing, but it's also going to create opportunities in the real economy, and you can be on in different parts of the capital stack to take advantage of it.
To wrap up, I have one question, the same question for both of you. I know that to be a great investor requires a lot of humility, but setting humility aside, what's the one thing you're most confident about for the next, call it 12 months? Joe?
The Fed will keep interest rates low.
I don't think you're going out on a limb there. How about you, Brooke?
This might be a little bit too meta, but I would say that most people will sit on their hands. Most investors are going to be afraid to act, and we'll see a lot of sclerosis and inactivity. So for those of us who are brave enough to not behave that way, it might be really a pretty great time to play offense.
Well, that is a great provocative thought to end our conversation on. Brooke Jones of Carnegie, Joe Dowling of Brown University's investment office. I want to thank you both very much for joining us here on Invesco Global. A great conversation about the challenges and opportunities facing the real money institutional investors.